The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
For equity bulls, is the bad labor market? Well, is that a blessing in disguise? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romain Bostic, kicking you off to the close here on this Friday afternoon. An S&P 500, which logged a record high on Tuesday, pulled back a little bit in the days since, now headed for yet another record high. Of course, it started earlier in the week because of optimism over a deal surrounding the Strait of Hormuz, and today's record high tethered to, well, I guess, deteriorating economic conditions, and more importantly, the optimism that rate cuts by the Fed may actually be back on the table. You see that reflected there in the 2-year yield, which at one point had dropped about 9 basis points on the day, though paring back some of that just a little bit. That backup in yields adding a little bit of a fuel to the gold rally, which is now back at its highest levels since the start of June. But that backup in yields also putting downward pressure on the dollar. The Bloomberg Dollar Spot Index right now headed back to its lowest levels since late May. We've been talking a lot about the macro. In fact, I told you at the start of the week that macro forces would likely bubble back up to actually be a bigger driver of the broader market as earnings season starts to subside. Today, a testament to that. That sharp decline in U.S. payrolls, down 23,000 last month, and the government revising downward the May and June figures by 103,000 jobs. The unemployment rate, it fell as labor participation, that fell as well, and wage growth, that was down too. All bad news for the economy, but in this topsy-turvy world, that might be good for equity markets that had been worried the Fed would be rushing to raise rates to fight inflation. But if the labor market is indeed on the back foot, then maybe that tells a different story.
I think it tells you that if data looks somewhat softer in the next couple months, especially when it comes to the inflation side, they're probably not going to want to hike in September. They're probably going to want to just see how the data progresses. Now, that's going to probably have to mean core PCE tracking below 0.25% roughly over the next 2 prints.
So off we go, but the question is, should we actually be going higher? Before the print, Michael Hartnett and his teams of strategists over at Bank of America, they were out with their weekly note showing that a gauge of investor bullishness climbed to the highest level since 2021. And just like bad economic news is sometimes good market news, overly bearish investor sentiment is sometimes a contrarian signal to reduce exposure. Should you? Well, this week, growth was the best performing factor on a long-short basis, while value was the biggest laggard. That was a flip from what we saw in July, where everyone seemed to be screaming quality, quality, quality. We talk about some of those factors out there and this idea here of how things will shake out for the rest of the month. It is August, after all, a busy August, but things are likely to slow down. Of course, they are also likely to pick back up should any of these catalysts move in the opposite direction of what the market had anticipated. Matt Rowe joins us here in Studio 2 to kick us off to the close, Managing Director of Solutions over at Man Group. Matt, great to see you here.
Good to see you, Romain.
Let's talk about the jobs report for a second and just kind of the macro conditions, because obviously the market was sort of kind of positioned for something else. I don't think anyone expected that amount of weakness. But of course, immediately everybody sort of started looking over at the Fed and say, okay, now what?
We're back to the bad news is good news for the equity market. And it's a little bit of a perverse incentive here. But the bad macroeconomic data, when thinking about the Fed's dual mandate, if the employment world is looking softer, then the probability of interest rate hikes is lower. And that, in turn, is good for growth equities. And so we see this cycle continuing and continuing. It's a big part of the reason why the 60-40 portfolio these days is really struggling and people's conviction, because you look at a day like today, stocks are up and bonds are up. There's not a diversifying characteristic between the two. It's a big part of the challenge.
Are you kind of surprised at just how more correlated the market has become over the last few weeks relative to what we saw at the start of the year, where it seemed everything was just kind of off on its own?
Yeah, I mean, the rally is driven by a very narrow breadth of the market, right? The large cap tech category is really what's driving everything higher.
I was actually surprised by that, because I remember when we hit that record high on Tuesday, I was looking at sort of what took us from that low in June to here, and it was 3 stocks. I mean, 60+% of those gains came from Amazon, Apple, and I forgot the other one, maybe Alphabet.
Exactly. And so even if you think you're diversified by owning index product, you're still rather narrowly concentrated. So it's a little bit tricky in that sense. And I think part of the reason why the market's feeling pretty good today and in general is we got that clearing print, if you will, from the situational awareness liquidity event where Citadel bought a basket of these growth names, and the market sort of took that as a signal of maybe this is a clearing bottom and we can move forward from here. But I think today is all about lower probability of interest rate hikes for now.
Well, with regards to situational awareness, it did rattle some folks because I think it kind of spoke to the idea of just kind of how on the precipice we are. Not necessarily that things are going to come down crashing, but that maybe people need to start rethinking those positions. When you looked at the earnings that we got out of some of these big tech names this week and the last week, whether it's with the hyperscalers or some of the chip makers, et cetera, what was your takeaway with regards to whether we might actually see further and more meaningful gains out of those stocks?
I mean, I think it's still measured by Capex, right? And like people know that there's a circular reference of what's going on in borrowing money, putting it into Capex, and carry on. And I can't help but draw comparisons to the telecom fiber build out of the late 90s, early 2000s. I'm old enough to have been there when that was going on, actually in San Francisco. And I think the cycle goes something like build excess capacity through substantial investment, which is where we are now. Nobody knows when that peaks, and people are still willing to chase. There's a fear from institutional investors broadly, not of the downside so much necessarily. There's more of a fear of being underexposed to the category right now. So because that's the herd mentality, you're going to see less people worried about career risk or about relationships with their investors if they underperform in a sell-off. The biggest worry is not being exposed enough to this category.
But is there a potential that could change, at least in the short term? And particularly because, I mean, some of those people that might be worried about their jobs, if they did their jobs over the last 6.5 months, they're sitting on some pretty healthy gains. And I do wonder if that changes the complexion of what we see later in the year, where maybe people start to pull back, not because they think a crash is coming, but it's like you might as well lock it in and not take any more risk.
Yeah, I mean, I think that's what leads to the seasonality effect, and part of the reason why post Labor Day tends to be a little bit more volatile. If you look at the seasonality of the VIX, the summer, it's not just a saying. There is a lull in the summer. There's fewer macroeconomic data points and releases. You kind of get a lull in earnings, and there tends to be a bit of a lull in activity. And I think going into the back end of this year, you are going to see a lot more of that risk management in Q3. And also, you look at the change from yesterday to today, the probability of interest rate hikes didn't get taken off the table completely. It just got reduced slightly. So I think there's going to continue to be this struggle with the market of reading Warsh. People don't really know what information is he going to give, on what frequency, how is he going to measure things. So I think we're in for a volatile Q3 and Q4 of this year.
What about the correlation between the AI build out and the Capex spend and the economy itself? I mean, because that's kind of been the stealth driver of this economy. It's been partly a stealth driver of inflation. But if you start to see hiccups there, does that then become an economic story?
Absolutely. I mean, I think that's the thing that the hardest thing for me and for the market generally to quantify is how big is this issue, right? Like how big is the positive impact and how big is the risk to the broader market? If you contextualize it to, as I referred to earlier, the telecom fiber build out and the global financial crisis driven by housing, the AI Capex boom is 2x what fiber and telecom was, and it's about half what the housing expansion was in dollar notional terms. But the speed of its impact on GDP has doubled both by a long shot. So why that's all relevant is that as fast as it can be contributing positively to economic growth and to GDP, if we see things go in reverse or a slowdown in Capex or start seeing winners and losers and some failures in consolidation, it could very quickly drag us in the wrong direction. So I think people are on pins and needles. I've jokingly referred to people being more worried about the golden swan than they are about the black swan. But I think as fast as it has arrived and contributed, if it were to hit a bump in the road, it could move things in a negative direction fast.
All right, Matt, always great. Matt Rowe,
Thanks,
Managing
Momei.
Director of Solutions over at Man Group. As he speaks, stocks hitting session highs as they're headed for a weekly gain. It's been a good week for stocks. It's also been a pretty good week for Zendaya and Tom Holland. Spider-Man, a blockbuster debut last week, expected to be the top movie this week. We're going to talk to the man who greenlit that film, Tom Rothman, the CEO of Sony Pictures Entertainment's Motion Picture Group. From cinema to politics, well, we're going to talk with Julie Su, the Deputy Mayor of New York City for Economic Justice, to talk about economic development here in the city, and of course that dreaded pied-à-terre tax. And education in the AI era. We're going to catch up with the new president of Spelman College, Dr. Ayanna Howard. All that and more coming up in just a second, right here on The Close, right here on Bloomberg. Shares of Gen Digital headed for a second straight week of gains, now at the highest levels in almost a year after boosting its earnings forecast. The cybersecurity company behind brands like NortonLifeLock also recently launching the Fearless Planet Index, which offers a live view of digital risk around the clock. Vincent Pilette joins us right now, President and CEO over at Gen. All right, Vincent, the numbers look good. We don't have to rehash them here, but give me a sense here. You're pretty confident here that you can continue this growth story for the next few quarters?
Broad-based performance, double-digit growth, and we've seen a rise in demand for our cybersecurity solutions as the anxiety with everything that's happening with AI, agentic solutions is penetrating into the overall environment. So yes, we feel very confident about the future, and that enabled us to raise our annual guidance.
Let's talk about the risk out there, because this is a good week to have you, because we've seen, of course, some interesting stories with regards to LLM sort of, I guess, venturing out on their own outside of the yard, other types of risk out there with regards to our digital footprints. What does your Fearless Planet Index do, and more importantly, what does it show right now?
So we have a broad-based customer environment, 500 million users across the globe, and we see a lot of what the consumers see in the overall digital environment. We've seen a rise of scams, a rise in personalized hacking for the consumers. And so we put this index together to show the consumers the overall threat environment they face in a specific country, in a specific cities, with the type of risk they can face.
So when we talk about some of these risks, we talk about obviously whatever AI and these LLMs could do, but there are some more pedestrian risk out there too. Obviously, most of us are familiar with the phishing scams. Just last week, we had the head of Verizon's products. They're trying to come up with new SIM cards that provide a little bit more protection for our phones. Are you seeing that as a tailwind for your business?
Absolutely. And initially, we classify the risk in two layers. The one that hits you directly, and there you have to be careful to not give your password, go on fake websites, provide different things. And then the indirect one, when an enterprise is breached or a local shop is breached and your personal data was used in the past for a transaction, and suddenly your personal data is out there in the dark web for people to use and create some adverse effect with a malicious intent. A third one now, in terms of risk and desire for the consumer to be protected, is what an agentic solution will do. What if an agent suddenly processes a transaction on your behalf, whether it's malicious, conscious, or simply a risk because the agentic solution is badly designed? And that's a new level of risk that the consumer needs to protect themselves for. So we embedded agentic security inside our Norton 360 so the customer can have a better control and visibility of what an agent would do on their behalf.
Well, that's what I'm curious about. We've spoken with a lot of company CEOs who run consumer-facing companies, and they are really hot on this idea of agentic shopping. The idea that their agents that are trying to sell me something can talk to my agent that is trying to buy something. But how do I have the confidence that they're going to be acting in my best interest and it's not just going to be hijacked and someone's going to empty out my bank account or my credit card?
You're totally right. And everybody would like to benefit from those great solutions, frankly, and agentic solutions to manage your financials, to manage scheduling your events, etc. It's all for the benefit of the consumers. But there is some risk associated with that, whether it's desired by hackers or if it's just a badly designed agent. And I think we are providing the same security we were doing in the normal scam environment to an agentic solutions, filtering the agent, going through an agentic trust hub that's able to verify the design of the agents and then giving you transparency and control on where you want to share your personal data on your behalf for that agent.
All right. Vincent, really great to have you here. We got to talk more in the future. Vincent Pilette, President and CEO over at Gen. Meanwhile, we're going to continue our focus on the AI and the tech space and talk with an OG in that space, Akamai. It's making a big pivot. It's costing a lot of money. We have the CEO, Tom Leighton, on coming up after the break to talk about his plan for the future. That's coming up next, right here on The Close, right here on Bloomberg. Shares of Akamai down after yesterday's earnings report. The company disclosing a new $600 million commitment with the U.S.-based tech company on its earnings call, bringing the total contract signed for its cloud infrastructure business to $2.8 billion this year. Joining us right now is the co-founder and CEO of Akamai, Tom Leighton. Great to have you here. Tom, we don't have to rehash all of the numbers from yesterday, but I do just want to get to this idea. I mean, the revenue growth is there. The profit growth isn't, but that seems to be somewhat deliberate as you're investing a lot back into this business. Why?
Yeah, the profit growth follows the revenue growth. So we're investing a lot now to build out the infrastructure, and then that's followed by the revenue and the profit growth next year. These big deals we're doing all in have operating margins from the low to mid 20s to low 30s, very consistent with the company profile, drive a lot of profit growth starting next year and into the future.
Well, you said on the call, I think, no acceleration in this quarter, Q3, but a hockey stick.
Yeah.
For Q4?
Yeah.
Really?
Well, you know, cloud infrastructure services grew 39%, so not exactly bad.
No.
And we think for the year going to be 50. So a big, we'll start seeing the revenue from these deals hit in Q4, and then next year we think it accelerates further, enough to drive the whole company into double-digit growth.
Some of the concern and some of the reasons why you've seen the shares down, you suspended the buyback to help build out this buyout. And based on the numbers I saw, you're guiding Capex at basically about 40+% of revenue, which is high for a company of your size, is it not?
Well, yeah, and we're making these investments to drive all that revenue and profit growth starting Q4, but into next year. And remember that this year we've already bought back a lot of shares, more that offset the equity dilution plus additional. And over the last 15 years, we've probably net reduced our share count by 15 to 20%.
Well, I'm curious about that. I mean, obviously, Akamai, a pioneer in sort of this idea of content delivery networks. I mean, we always kind of say, you're kind of the hidden sort of juice behind the internet. We're entering this new phase with AI, and we talked about the deal at the top here, which I think focuses a little bit more on AI robotics. What are you trying to build now? Is this? I mean, I know the CFO has talked about this being sort of a once-in-a-generational opportunity. Are you making a big pivot here?
Yeah, we're going to do the same thing for AI that we did for content delivery and then cybersecurity. And think about robotics. You got a fleet of robots or devices, might be cars. First, they got all sorts of sensors. They got to look at what's going on around them and feed that back in. And that's a lot of video. And if you're doing this at scale, you need to do that, more distributed fashion, just like, delivering a sporting event. You can't do that from a big data center. You got to do that in a distributed fashion. And then you need the AI to process that video and issue instructions to the robot or the device. And if it's a car or if it's a robot interacting with a human, you want that to be fast. You don't want to have latency. And so doing it in a distributed fashion, like Akamai is uniquely capable of doing, is great for performance and for cost.
Well, forgive me for being a little ignorant of this, but are you doing something that the hyperscalers that are building all these data centers that they can't do in terms of fulfilling that? Yes?
Exactly. I mean, they're very good at training the big models. We are very good at training the medium-sized models and doing the inference, actually executing on it. In fact, all the hyperscalers use our cloud infrastructure services for the kinds of applications where they want to have the logic, the compute logic, be close to the user for performance.
We'll talk about sort of this acceleration that I mentioned the hockey stick and all that, but give me the sense here of the demand that you're seeing, the capacity that you have or you think you'll have to meet that demand. Is that in sync?
Yes, of course, We wouldn't take on a deal that we didn't have the capacity to fulfill it. And it is a hockey stick because this year we've signed up already $2.8 billion in multi-year commits for the cloud business. Really, just taking off.
Well, I mean, is there a concern about customer risk? I mean, when you say commits, I mean, these companies can pull back if for some reason they feel like, okay, we're spending too much, and maybe we do that. But you're confident that the pace of spending that we're seeing, whether it's to Akamai or to the broader space, is going to continue?
These are committed contracts. I mean, the only way out of that is the company goes broke. I don't think that's likely in these scenarios. And even if that, in that crazy case, if it happened, what we're buying, the assets, still have tremendous use. So in the case of GPUs, we are still selling at capacity the GPUs we had 6 years ago at a higher price than we sold them for 6 years ago.
So when you hear people criticize this AI build out and try to make parallels to the telecom boom and bust, what do you say to that?
Well, I think the concern there really is more around these gigantic data centers and training the gigantic models with the latest hardware. That is not what we're doing. We are doing modest-sized build-outs for the enterprise use of AI. That's not going away. That's going to keep growing.
What about your costs? I mean, we've talked a lot on the show, price of memory chips, price of everything, really, to build out this AI infrastructure is through the roof. How are you managing that?
Well, in some cases, we've raised prices. And when we take on these long-term deals at the large commits, that's all factored in. So we've already locked down what our costs are in the contract. So if certain cases, if there's a variable cost, that is passed through so that we're protected.
When you're assessing the customers that you're taking on, and more importantly, the concentration of customers, we've seen with other companies, a huge chunk of their revenue is coming from 2 or 3 players.
Right.
Is that a concern for you? Do you think that the breadth of customers that you will have will be there?
Oh yeah, we're very distributed. We have a small handful of customers, over 1% of revenue. Okay. Collectively, all the big ones, less than 20% of revenue. And those are the name brands that I don't think people worry about having financial problems.
My last question, and this is less about Akamai specifically, and just more about what you've seen over the years in your career. I mean, what are you excited about most when it comes to just everything going on right now with technology and the way it's being integrated into our society?
It's an exciting time, and good in bad ways. And for us in 2 dimensions, driven by AI, because it's changing everything. And a fast-moving landscape, we're in a great position to help enable that. The downside is AI is used for cyber attacks. The bot armies that we're seeing, probably 10 times larger now than they were a year ago, because the adversaries using AI to take over devices. The penetration rates for enterprises much higher, going to get worse. As you have more AI in the hands of the attackers, they find more zero-day vulnerabilities. Now, again, that's a tailwind for our business because we protect pretty much all the world's major enterprises. We see that zero-day first, put rules in the defenses to protect our enterprise customers.
Tom, great to have you.
Nice to be here. Thank you.
Tom Leighton, co-founder, CEO over at Akamai. When we come back, we're going to talk to the head of Sony Pictures.
That it is possible when you talk about Spider-Man, when you see our new Spider-Man movie, yes, there have been many, but this one's different. And as long as you it's much more emotionally driven, it's much more grounded. I actually myself refer to it's more a super person movie than even a superhero movie.
That was Sony Pictures Entertainment Motion Picture Group Chairman and CEO Tom Rothman. He came on our program back in June discussing what would go on to be the biggest cinema debut in history. We're talking about Spider-Man, and Tom is back with us here in Studio 2 today. All right, Tom, I had to play that clip because you called it. I mean, we were being glib with you. Look, I don't think anyone doubted this was going to be a big movie. It's a record-setting movie. It's huge. Just talk about just sort of the process, though, of getting this movie out the door and why you had so much confidence that it was going to do so well.
Well, it's my job to be confident, but I was because I'd seen the movie. And ultimately, I thought we did a really terrific job in the marketing campaign and distributing it, and be interesting for you probably to know that it was the widest release in movie history. If you include China, it was on over 80,000 screens worldwide on the same day, and that's a big undertaking. But the reason I was confident is the reason the movie's done well, and that is it's very, very good.
Well, I mean, obviously there's always this concern when it comes to these superhero franchises that after so many iterations of it, it's hard to come up with something novel and unique to excite audiences. So when you saw the script, when you started to sort of see this mapped out here, was the sense of like, let's really try to do something different? Or?
Yes.
Yes. Yeah.
Yeah, the sense was.
So you pushed for that, yeah.
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 I mean, everybody involved did, and the credit really goes, marvelous director, Destin Daniel Cretton, a name with which you will become much more familiar as the years go. I think it pushes him into the first rank of filmmakers.
Yeah.
And Tom Holland himself was very involved in the development of the script.
Yeah.
And everyone in the studio felt that we did need to do something different, but not necessarily bigger in a conventional sense, not necessarily louder. But actually what we went for was something more emotional, something deeper. And the audience has responded. It's not just the record-setting box office, it's that our audience metrics coming out are just through the roof.
Well, I am curious about that. I mean, obviously on a revenue basis, box office basis, record.
Yes.
Correct me if I'm wrong, but the budget for this was like $225 million.
Well, I don't comment on the record on that, but you see, I'm not disagreeing with you.
Well, I mean, I guess what I'm getting at is what is the potential profitability of it? Because for a movie of this magnitude, that actually seems somewhat light. I mean, Christopher Nolan would have came back to you for a couple $100 million more. But you managed to make this on that budget based on Bloomberg reporting. So, I mean, anyone could do the simple math here. I mean, this is setting up to be one of your most profitable movies.
Yes.
Yeah. Okay, okay. We'll leave it at that. So good for you. What else, and not to just sort of minimize this, but for the rest of the year, I mean, I know you got like Resident Evil and a couple other ones, but do you have anything that's going to even come close to this?
Well, we have a very, very big movie at Christmas, which is the conclusion, really, of our Jumanji trilogy.
Oh, yeah.
And that's a franchise that's done, I believe, well over $1.5 billion, almost $1.5 billion, between $1.25 billion and $1.5 billion in global box office. Tremendously popular, and we're right on Christmas Day with that as this sort of all-audience fun. Have a good time at the movies alternative.
Well, you were banging this drum back in June on this idea that people want to go back physically to the theater, and maybe not just Spider-Man, but Odyssey, a lot of things outside of Sony as well also have done great. And obviously, if you're in the Tom Holland Zendaya household, you're having a great summer here.
That's for sure.
But what's driving that? Can you articulate what's driving that?
Yeah, I can. I think it's the old line, and I never knew. You probably would know better than me whether it was in fact Mark Twain or W.C. Fields who said reports of my death were greatly exaggerated. Reports of the movie business's death were greatly, greatly exaggerated. We went through COVID, an impossible circumstance. Then we went through a terrible strike, which was extremely destructive and really compromised the amount and the variety of product that was in the theaters. And now it's back. There's great product. And I think the thing that's really encouraging about it is that young people are going back to the movies. 2019, right before the pandemic, $11.5 billion in the box office for North America. Right now, based on Bloomberg estimates, we're tracking at around $10.2 billion for 2026. That's up 15% from 2025, still short from what we saw in 2019. Yes.
You think, A, we're going to surpass 10 billion, and B, do you think we could potentially get to 11?
I think eventually we get to 11, although I must say, in being fair, that I believe we will get back there in terms of revenue. Will we get back there in terms of admissions? Because a lot of the revenue makeup has come from raising prices. And this is something which I don't think is good for our business. I think we have to push, and we have to push exhibition. The studios don't set prices. We're not allowed. The theaters themselves set the prices, and I'm not saying anything that my friends in exhibition don't know, I think, which is that it's important that we keep going to the movies affordable, and that we push to make it more affordable again.
Well, that gets to the idea, and when we were talking last time about why you would go to the theater as opposed to watching at home. I mean, the price proposition is one reason why streaming kind of took off for a lot of folks, and there's still a lot of competition there. And I'm just curious about your relationship with the streaming services and how you're balancing out theatrical releases with whatever you're sharing with the streamers.
Well, I think it's done right. I think it's very mutually beneficial. So we at Sony have a very big, very lucrative, very valuable deal with Netflix. They're excellent partners of ours. But that is to use the movie term of art, that is windowed, which is it comes after a period of exclusivity in the movies, in the movie theaters, and after a period when there's transactional home entertainment.
Yeah.
Done in that way, it can be a very healthy ecosystem.
But you're also fighting for this exclusivity over talent. I think about David Fincher being attached to that last Netflix piece, and Quentin Tarantino, which is one of your guys, and he's kicking around, right? I heard he's going to do a new play.
That's true.
In the West End. I forgot the title of it. It sounded ridiculous.
It's called, it's not ridiculous.
Yeah.
It's very, very funny, but I'm not sure
and
if
you're
that's
producing
public yet. Sony is producing that along with Sonia Friedman, who's the top West End producer. And Quentin is he's a very, very dynamic artist who likes to do lots of different things. He's published several books, best-selling books. Yeah. Obviously, tremendous screenwriter, film director, and now playwright.
A playwright, and as a film director, he says he wants to make one more film and be out. Is this play going to end up being the next Quentin Tarantino film?
I hope you get him in this seat and you ask him.
I mean, you probably have more of a direct line to him than I do. I do want to ask you, you mentioned kind of the relationship with theaters. I mean, this has been a great year for all around, and I do wonder if. Forgive me for phrasing it this way, if the theaters owe you something.
No. Well, do they owe me something? No, they don't owe me. The studio something. Do they owe their customers something? Yes.
Yeah.
And I think there are a couple things they owe their customers. One, incumbent upon us. They can't give them customers programming that the studios don't supply. So we owe their customers a variety and a range of programming so that everything isn't the same. And then they owe their customers quality experience. They owe their customers nice theaters, and a lot of them invested a lot of money in them. Nice seats, good theaters, good food, but they also owe them more reasonable pricing.
Before I let you go, Tom, I do just have to ask you about kind of just the state of Hollywood as an industry.
Sure.
I mean, obviously, we're still waiting whether Paramount, Warner Brothers gets combined here. But what's the net effect of all of this with regards to that merger and just everything that's been happening in Hollywood with regards to jobs and whether those jobs will still be there in any sort of material way?
Well, I think it's obvious that it's been reported, I'm sure it's been reported by Bloomberg, that there's been a significant net loss of jobs, certainly in Los Angeles. Certainly Los Angeles has suffered. And I don't see that consolidation lessening. Whether it's this particular merger or others, we've gone through a strong period of consolidation ever since basically Fox and Rupert Murdoch chose to sell the studio assets of Fox to Disney. That began a period of consolidation. And that's resulted in a net loss of jobs, and runaway production has also cost jobs. And I think that's a very significant factor, which is it's very difficult for us to make movies in California because even though they have increased their tax credit, the way the tax credit works is simply not competitive. It's not competitive with other jurisdictions, and until it gets competitive, and until there is a tax credit on what we refer to as above the line, which means the named talent, it's not going to be competitive. So all of that has definitely put pressure on the employment picture, certainly in California. There's no question about that.
All right, Tom, really appreciate you
All right,
being here.
man.
Congratulations.
Good to see you. Thanks a lot.
Absolutely. Tom Rothman there,
Take
Sony
care.
Pictures Entertainment, Motion Picture Group Chairman and CEO, fresh, of course, off that record box office haul for Spider-Man, which is expected to be the #1 movie out there this weekend as well. Meanwhile, we want to continue here our discussion with the parade of CEOs that we've had here on The Close, and that includes the CEO of Once Upon a Farm. The children's food maker reported earnings yesterday, 42% sales growth in the quarter. Joining us right now to talk a little bit more about this is John Foraker, the co-founder and CEO. All right, John, let's get right to this idea here of exactly where we go next. When it comes to this growth story, 42% growth is great. Can you sustain it?
Yes, we can. We have very resilient consumer demand for our products, and we're resonating across baby all the way through kid, which is where our brand meets consumers, and we're in a really good position to continue to grow. Such that we raised our guidance for this year, and our outlook for the future is increasing.
When do we start to see, though, maybe a little bit more margin expansion here? What's holding that back?
Yeah, our business has been growing really fast on the baby snack side of our business, which is a great thing. That mixes our business a little bit unfavorably in the very short term. That's been a factor that we're facing, but we expect margins to continue to grow over the coming years. We talked about productivity investments that we'll be making in our plants and things like that, starting in 27, that are going to be significant. And we're very confident in this company's ability to drive really strong long-term profitability, and we'll see a significant inflection upward in our adjusted EBITDA in 27. So we're feeling really good about all that stuff. We're right where we want to be.
Is there any concern, and I know when it comes to children's food, most parents aren't going to skimp, but we talk a lot on this show about certain consumers being a little bit stretched right now and whether that actually gets worse. I mean, what is kind of the buffer that you have? Is what you do, I won't necessarily say recession-proof, but recession-resilient?
Certainly recession-resilient. We are, baby and kid food is kind of a sacred space for parents. They're looking to make sure that their kids have the most nutrition that they can get into them, and no added sugar and all these things that are really relevant. So we know that we perform really well in middle and even lower third income houses. We perform right to the category because we know that consumers are willing to make trade-offs to prioritize the products that we have. We're in a really good price value place. And also our products show up in retailers that tend to do really well when the economy gets soft. So I think we're well positioned for the future, even if the economy continues to be a little bit iffy.
With regards to your own costs, and particularly labor costs, and I think either you or the CFO kind of talked about this on the conference call, this idea of that being one of your single biggest costs of goods. How do you manage that, if at all? Is there any wiggle room there?
Yeah, we have opportunity to invest in capital equipment in our plants to make them more efficient. Automation is a really important factor, not only to get more efficient, but also because we need the extra capacity to support our very strong growth that we expect into the coming years. So we're accomplishing both of those things by making those kinds of investments and just managing the business for the future.
I mean, this company, obviously, it's gone public earlier this year. I mean, you were kind of, did this playbook at Annie's. You've done it again here. As you sort of move forward with this idea and the idea that you have to sort of, answer to Wall Street investors, I do wonder where you see this company going. As an independent company, does it become like an Annie's where it gets absorbed into some other, big food conglomerate? What's your plan?
Well, we took it public to keep it independent, to allow us to invest in our continued growth of the business and our products. We're a public benefit corporation, so we have a very strong set of values around the way that we're going to grow this business and our standards for our products. We want to drive impact as well as really strong profitability, and we know that that's the right way to grow the brand for the long term. There's always been strategic interest in this business. There probably will be in the future, but our path really, we think, for creating most value is to build this into a business that can be north of $1 billion in revenue. And we are on our way, and we just got to keep executing.
Yeah, I asked that, and I don't mean to be glib about it, but I mean, Annie's was public for 2 years. I mean, you went public, and then General Mills snapped you up for obvious reasons. Why? I mean, look, if you guys are actually going to grow at some of the pace that you're out there, I'm sure some of these big food conglomerates are going to come looking at you pretty soon.
Yeah, I mean, it's flattering. The reality is when you're a public company, you have a fiduciary responsibility to do right by shareholders. And we do expect that in the future there may be some interest. We just want to make sure that we grow the business, and that if we were to partner with somebody like that in the future, we just need to do it in line with our values. And as a public benefit corporation, that's really important to us.
Talk about your product lineup, and more importantly, the expansion of it. You kind of committed this idea of entering a new category every, I think it was every 12 to 18 months or so. Can you give me a sense? A, you still stand by that, and B, you have enough confidence that you're going to have enough ideas to do that?
Yeah, we have a very long, 3+ year pipeline. We've been working on a lot of these ideas for many years. We'll definitely be going into at least one new category next year. That's our plan. We could do a little bit more than that, but on average, it'll be one every 12 to 18 months. The most important thing for us to do is really focus on our core categories, our kid and baby pouch business, driving more coolers in the baby aisle, and our snacks business, which is really on fire. And then just driving stronger profitability and growth out of that. And that's absolutely what we're focused on as a priority. But we do believe that taking this brand baby through kid, there are big kid categories that haven't really seen a lot of innovation focused on health and wellness. We think our brand is perfectly positioned to be able to talk to consumers and bring that trusted consumer along with the portfolio as we grow.
Well, we'll just kind of square the circle, though, because I did see that baby pouches actually slowed in the most recent quarter. Yep. But then at the same time, it says that baby overall, and not only did it grow, whatever it was, 70+%, but the idea that a lot of that was actually taking share from Gerber and some of the more traditional the legacy companies out there.
Yeah, on a quarter-over-quarter, the baby pouch business was a little bit slower, but that's really just a quarter-to-quarter timing thing. We're going to be putting a lot of baby coolers. We're putting them in right now in Q3. So the that baby pouch business will continue to grow very rapidly into the coming years. We're expecting to end the year with about 5,000 coolers out in retail, where we ended the second quarter at about 4,100, and then 8,000 next year, and ultimately at least 15,000, maybe quite a few more. So there's a lot of growth ahead on that business. It's one of the best margin profiles in our business. We really feel well positioned to continue to grow that business.
I just wanted to ask you just kind of about broader trends right now going on in the food space. The idea of a bigger push for less ultra processed foods, basically things that are more healthy, organic, natural, if you will. This is obviously right in the sweet spot of where Once Upon a Farm sits. I assume that's a tailwind, but I am curious as to whether you worry at all about fads. The idea that, okay, you can have a huge swath of the population decides today we want to be organic, and then a couple of years from now they're on to the next thing.
Yeah, we definitely don't want to play fads, and we don't. In organic, I've been, as you noted earlier, I ran Annie's for many years when organic was a very small thing in the U.S. It's a many times bigger business now. There's been a tailwind at the back of organic and cleaner, healthier food for many years, and that absolutely continues and actually has accelerated a lot over the last couple of years. And we see no change in that. We're definitely not diving onto like the fad trend of the day. We are really looking at like functionality, like immunity, brain health, protein, energy, things that parents are really interested in bringing into their kids' diets, baby through kid, and just bringing great whole nutrition made from real whole vegetables and fruits, and now even meat proteins in some of our baby items. Those are not controversial. They're not really fads. Those are basically just bringing great whole nutrition to parents that they're looking for.
Talk to me about marketing and the spend there. I mean, Once Upon a Farm, for a lot of people, is still relatively not necessarily in the zeitgeist. I know Jennifer Garner brought a lot of attention to it, but as you know, being in the food business, you have to put marketing muscle behind this, and it has to be consistent and constant to keep people aware of who you are.
Absolutely. Yeah, no, we've invested from the very beginning here in really strong full funnel marketing. Obviously, having Jen as an extremely involved and active person in the business from the very beginning when I joined in 2017 until now is very important. But we've really been talking about building the brand, with mainstream media, television, streaming, and all the influencer and peer-to-peer tools. We're doing it all. We're leveraging that marketing as we grow, but we're investing significantly in that, and we will continue to do that because, we're in 6.2% household penetration right now. That's grown a lot from last year, but we have that number can triple, double or triple, and so there's a lot of consumers that still don't know us and absolutely don't have us in the household, and we want to become a household name for baby through kid, and with our broad portfolio that's out there now and that will continue to grow.
All right, well, it looks like things are starting to perk up here after that earnings report. Shares up for a fifth straight day, second straight week. John, really appreciate you joining us. John Foraker, co-founder and CEO of Once Upon a Farm. Those shares right now up about 2% right now as we head towards the closing bells. And it does look like all of the major indices are going to finish the day in the green, barring some huge turnaround in the next 9 minutes. The Dow only up about 0.3%. The S&P is holding right near a record high. But the NASDAQ, those tech stocks, really getting a strong bid here on the day. The NASDAQ indices each up about 1%, but small caps participating as well. You put that all together, and this is a relatively broad-based rally to end the week. A drop in yields and some moderation in oil prices. That is helping just a bit, particularly coming off of that big jobs report that we had earlier this morning here in the U.S. And, well, it actually wasn't big. But, of course, the flip side of that is a weaker jobs market maybe takes rate hikes off the table and maybe puts rate cuts back into the conversation. As we move closer to these closing bells, we want to bring in Dana D'Auria, Co-CIO and Group President over at Envestnet. Dana, great to have you. Before we talk about the tech trade and stuff, I do want to get your initial reaction to what we learned this morning with regards to the U.S. labor market and obviously the feed through into the interest rate story. Are we making too much of what we learned, of what we saw this morning?
No, I mean, I think it's a very relevant indicator. I think it sort of boosts the decision not to raise rates and, puts pain a little bit to a lot of the chatter that it was, that we're in irresponsible territory. I think, it kind of boosted the Fed's hand a little bit as it has been, right? That we don't need to necessarily raise rates. And certainly the immediate aftermath was, of course, an assumption that maybe even September we're still good. Now, of course, we have inflation coming out. That'll be the new news in a week. But, losing 23,000 jobs, revisions down for more than 100,000 jobs, it's significant, it matters, and it says in terms of the Fed's dual mandate, there really isn't a reason based on the employment picture to be thinking about raising rates right now.
Yeah, we get those CPI and PPI numbers next week. Also going to get a read on retail sales. I mean, from your view, what is kind of the state of the consumer? And I mean that more in the context of how that feeds into the stock market and corporate profitability.
Yeah, no, it's a great question. I mean, we had the GDP report, the preliminary GDP report, and personal consumption was actually pretty strong. I mean, notwithstanding the overall, the headline number was actually not that exciting at 1.5. But the personal consumption part, the private sector, if you will, was good. It was stronger than expected. So, we've been talking about this theme for a while, I think, where you get these consumer confidence surveys that are concerned and inflation is a worry and, pain at the pump, et cetera, et cetera. But at the end of the day, the consumer is actually holding pretty strong and also holding pretty strong our corporate profits. So you have these strong fundamentals still boosting up the economy, I think. And, until you see some real cracks there, you have a lot to be happy about in terms of just where the market is at the moment.
How do you feel right now about the state of the AI trade? It's kind of had a few fits and starts over the last few weeks here, despite some of the earnings that we got that were phenomenal, both in terms of revenue growth, but also for profitability for a lot of these companies. But for some investors, they seem to be kind of souring on it a little bit.
I mean, you asked the question that reverses what I just said. Absolutely. If there's something that, we have to worry about, look, markets are forward-looking indicators, right? And you have corporate profits doing well, but you also have an expectation at this point that AI is coming in to bring productivity increases. And this is a theme I've talked about a lot. AI has to get past the point where semiconductors are doing well. Now you're seeing software providers who maybe can get some benefits from AI. But at the end of the day, the market is priced with an expectation that we're going to continue to have great growth. AI is clearly a part of that. And so that AI trade continues to sort of cause markets to oscillate, right, between fear and greed. On the one hand, you've got $700 to $800 billion in Capex for this year. That number keeps ticking up every time we look at it. And you don't exactly know when that's going to filter through to the Main Street economy. But on the other, the potential for it to increase productivity means inflation is not as much of a concern. Growth is doing well. And if you're, notwithstanding human capital, financial capital makes out on it. So It's a huge driver.
Well, then that raises a question. I mean, particularly given the outsized importance of AI to this market and to the economy. Obviously, the consumer still outsized importance as well. Is the stock market, I know everyone likes to say, oh, the stock market isn't the economy, but to a certain extent, at least in this moment, is it maybe one of the more better barometers of the economy?
I do think the stock market is a good barometer. It's a good barometer, but it's a noisy barometer. So I say good in the sense that if you really what we want from our barometer is not a measure of today, but what's going to happen. And markets are leading indicators, right? And so from that perspective, less a barometer and more a predictor to the extent it can be. But it's noisy as heck, right? And the volatility that we're seeing right now is, kind of it's made worse, I think, by the fact that we have this concentration in the AI trade in these companies that are dependent on the AI trade. So it's sort of where goes the AI trade, goes the market, right? The entire market is sort of one gigantic levered bet at this point to this trade. And so it's going to impute a lot of volatility. It's going to be difficult to even diversify away from that. You certainly can diversify, but it kind of drives so much of it. So I do think in this case and in general, the market does help us see where the general economy is going.
With regards to that volatility, particularly as maybe we get through this summer and a lot more people come back to their desk in September, there's been some speculation that the market could be in for a rough go, given all of the outsized gains that have already been made. The idea that some people are just going to want to book those gains and not sort of stomach the volatility for the rest of the year. That's seasonal, but I am curious if that should be something you worry about. No?
Yeah, I wouldn't act on it. I mean, I think, you do have the seasonal aspects. You're quite right. October, et cetera. You do have midterms. You do have the concern that's, constantly cascading, which is the AI trade really going to pay off? Is all of this spending going to pay off that quickly? Mm-hmm. But, that's the fear side. The greed side is going to be there too, right? And as you see, corporate profits coming in a good way, as you see companies announcing we are figuring out ways to use this, I think that's on the other side of that. Yeah. If the labor market can stay strong and if we can keep inflation reasonable, there's a lot of reasons to be happy.
All right, Dana Doria over at Envestnet counting us down to those closing bells.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick taking you through to that closing bell. It's a global simulcast. Carol Massar, Tim Stenovic, they join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube, with an S&P 500 set to close out the week at another record high.
And then I was looking at the weekly numbers, up, 3.5% on the S&P 500. I almost couldn't believe it. Because it just didn't feel that way, considering some of the churn in the market. But
yeah, it was kind of like a stealth rally, if you will, yes. Because we kind of had that midweek swoon. But yeah, you're right, 3.5%, 3.6% to be precise.
Okay, well, there's still, one more minute, so we don't know.
Tim, there you go, Tim.
I love that you're always so exact.
If you're impressed by 3.6%, look at the NASDAQ composite, up 5.3% for the week.
Wow.
Yeah.
Well, there you go. I mean, it gets to this idea that at the end of the day, with this rotation that we continue to see underneath the surface, so that when sort of one group, one sector or one group of the market sort of does poorly because of shift in sentiment, usually something else picks up that mantle. Today, obviously, though, we have to address the elephant in the room, is that obviously a lot of the green on the screen in the equity markets is tied to some of the red that we saw out of that jobs report earlier today.
Right. A weaker report, right? And the expectations is that maybe we don't get the Fed raising rates anytime soon. But there's a lot to go before we get to that September rate decision.
A lot to go here, and of course, in addition to that jobs report that we just got earlier this morning, a reminder that next week we are going to get that inflation data. Of course, the other side of the Fed's mandate, CPI and PPI prints coming down the pike. A relatively lighter week for earnings, but still some consequential ones that could potentially move the market. As for today, the S&P 500 is going to close at a record high. It's up about 47 points on the day, 0.6%, 3.5%, 3.6%. On the week. The NASDAQ composite adding more than 300 points or 1.3%, up 5% on the week. Similar story for the NASDAQ 100. The Dow Jones Industrial Average only up 0.3% on the day, but it is going to finish the week higher by 3%, and a 3.5% gain on the week for the Russell 2000, which adds 1% on the day.
That's your little buddy, right? That Russell?
I like the Russell.
I know you do. I know you do.
It's a little engine that could.
I know, always is. All right, S&P 500. I'm going to go back to the large caps, if I may. Most names in that index higher today. 321 names gaining on this Friday, Romaine. 180 to the downside.
180.
Are you drinking?
I was. I was taking a swig of water. You know, I have to wet my whistle.
He's the only one. To be fair, he's the only one on doing the talking.
I have to do all the
there.
heavy lifting on this show. So let's get right to it. We take a look at the IMAP, and actually, this is kind of what a lot of people have been talking about: the idea that this does not necessarily have to be a tech-led rally. It has still been relatively concentrated. Today, materials got in on the action. That is the outsized gainer on the day, up about 1.5%. Discretionary stocks were up there as well. Tech stocks also up about 1%. Your laggards were in communication services and in energy.
Are you hating on the tech stocks?
No, I love tech stocks.
All right, just making sure.
Look at all those double-digit gainers.
Every night I go to bed, I just talk to Claude.
Tim was like,
hello, Claude.
I say, hello, Claude.
What does Claude say back to you?
You really are a lonely man,
You
right?
don't want to know what Claude says to me. Dark things.
Does nobody want to talk to you or play with you or be on set with you?
Romaine, call me.
I will.
We'll talk.
I don't have your number, but sure.
All right. Let's call Airbnb. Apparently investors are. Let's get to it because that is definitely some outperformance in the session. This one up 17.4% in today's trade. Top gainer in both the S&P and the NASDAQ 100. Company boosting its annual revenue forecast for a second time this year. They cited robust demand in the U.S. and Europe. Company now sees annual revenue growth improving by a percentage of at least mid-teens and boosted its full-year margin forecast for adjusted earnings. Optimistic outlook suggesting that travel demand does remain healthy. Overall, nights and seats booked jumping 10% to 148.3 million in the second quarter. They're also renting out, apparently, boutique hotel rooms. So this is a new revenue stream for them. The stock now up about 28% year to date. Let's flip it on over to SpaceX, if we may. This one up 16% in today's session. Top gainer it was in today's trade, the NASDAQ 100, continuing the climb that we saw yesterday. That came after the release of as many as 911.5 million shares worth about $100 billion from those lockup agreements. So investors snapping up the shares. It's been a bit of a roller coaster ride, we know, since the IPO. Stock, though, $133.11, so just below that IPO price closing here. And I think the stock is up roughly about 19% this week. Let me just see if it made the 20% mark. Yep, up 22, almost 23% for the week overall. And then let's go on over. I hope I gave the right ticker. Microchip. Thank you, Lizzie. Thank you. A top in the S&P and NASDAQ 100, that went up about 13, almost 14% here. Semiconductor manufacturing forecast, company forecast adjusted earnings per share for the second quarter and guidance that beat the average analyst estimate. We did see some analysts raising their price targets, some lowering. Stocks up more than 30% year to date. What?
All right, Tim, go.
Okay, well, I think Romaine wants to talk Dunkin and coffee. I do too. We'll get there in a second. I want to start with Trade Desk, the worst performer in the S&P 500.
Always, aligning with
down 22% today. We covered this briefly yesterday when the company was out. It reported earnings for second quarter and gave third quarter revenue that really missed average analyst estimates. Shares are down 89% since 2024 highs. At least 4 brokerages have downgraded their rating on the stock after this latest report. Once again, Trade Desk down 22% today. Let's go to retail and apparel and talk Under Armour a little bit. The company forecast sharper revenue decline than previously expected as demand softens in several key regions. Shares down today by 4.5%. The company's been trying to turn around its business by cutting its product offerings and reducing discounts. And then remember, they lost Steph Curry, and that's added additional pressure as well. 4.5% to the downside for Under Armour. And finally, shares of Sweetgreen. Romaine, I know this is one of your lunch spots. I went today to do some research. It was, no joke, empty today. Midday on, to be fair, it's a Friday in Midtown Manhattan. I don't know if anyone comes into the office except for us. But there was nobody there, and that's the concern that Sweetgreen has right now as it continues to battle the Cyclospora outbreak, even though its products have not been linked to what has happened with certain packaged lettuces. Shares down 8% today after it downgraded its net sales for the year. Yeah,
we're going to hear from Kava next week with their earnings. As far as the yield picture, keep in mind on a weekly basis, the dollar is down. So too are oil prices, and you're seeing yields drift down as well, down about 5 basis points on your 2-year yield. The 30-year yield down 3%. Meanwhile, Carol, there's something I want to talk about.
Yeah.
Because right down the street from Bloomberg World Headquarters, some new coffee shop opened up.
Can you see me?
I was like, I'll check it out. It's called, what is it called? Watch House?
Watch House.
Watch House. This is clearly not for me. It is very fancy coffee, very expensive coffee. Our producer came in the other day and she was complaining. She was like, I paid like, $40 for this and all I got was like 6 ounces.
Lizzie? Meredith? Which one?
I don't know. Why are you calling her out?
Queenette?
What's your problem?
No. The Bambito Estate? Is that what she has?
It comes with green tea as well.
Beans from a family
All right, so this is a luxury chain.
It's only $32.
It was just popular overseas, and they do have a variety of offerings. You can get regular coffee for $4. I'll keep this conversation going, Carol.
Don't hate on it.
Hey,
if you want to pay $32 for a cup of coffee, you get the Bambito Estate, steeped from beans from a family farm in Western Panama, and served with a side of cold brewed green tea. Tim, have you been there?
I have not been there. I am a fan of pour-overs, though. I've been known to pour over coffee of my own. You can do it at home, too, and it still tastes really good.
But people like the experience.
Romaine,
they want to be out.
Wait, which way am I pointing?
Maybe Claude will take you for a cup of coffee.
This one, Romaine? Oh, my God. He's a little bit of a primo when it comes to coffee.
Yeah.
I had no idea because he never drank coffee at work.
I don't drink coffee at work.
That does not surprise me at all, Carol Master.
I know. I know. Now that I've spent some time working.
You probably got one of those fancy, like, Italian espresso machines.
I do.
House,
Yeah. The Bizzarra BZ10.
Okay, I don't know what that means, but it sounds expensive. Well, speaking of expensive, if Watch House isn't your thing, maybe Dunkin is. Interesting promotion going on. There's this marketing campaign out there by a company called Craze, where basically if you buy things at certain stores, you get a $10 gift card for Dunkin. Well, as young people tend to do, they found a way to really sort of game this system. Let me talk to Tim. Tim, to game this system, so explain how this works. What's going on? So the idea is they just keep buying things, spread it across all their credit cards.
There.
I guess, okay.
Yeah.
Write me in. This is how we feel.
They buy $10 gift cards. They make
squeezed
transactions close to $10 to maximize their reimbursement. Mm-hmm. Some have been able to redeem hundreds of dollars in credits. I don't know how that works.
I don't either.
Maybe we're not. Let's just say the demographic.
I'm not the demographic of either one of these.
I don't think.
Carol's holding up a piece of paper.
I'm sad.
It's a frowny face. Why?
I'm sad. Look, do you see my eyes? They're X's.
What's
wrong,
you guys
Carol?
do in the studio all day?
Sorry?
Nothing. I think we have to go.
Hey.
Romaine,
I haven't really been talking today.
Are they bringing you a co-anchor next week?
No, I want them to bring me a $30 cup of coffee.
$32, not including tip.
I'm not even going to get you a $10 gift card.
Okay, good night.
Just going to tell you.
Claude will get it for you, Romaine.
Kind of love you. Have a good week.
Kind of.
All right, that is a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. Romaine, all alone there on TV, on the close, continuing. Tim and I back here on Bloomberg Business Week Daily. We will see you. Well, I won't see you guys till Wednesday, but Tim and Romaine will be back here on Monday.
It's still Friday, and we're going to wrap up a big week in tech. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The closing bells rang just about 11 minutes ago, closing out the day, closing out the week. The S&P closing it out with another record high, its second record high on the week, up 0.6% on the day, more than 3% on a weekly basis. A big part of the reason was the downdraft that we saw in yields on the day and on the week, a downdraft that we saw in oil prices, softness in the dollar, and all that actually giving a slight boost that we saw today on gold. Meanwhile, as far as some of the individual movers, Sweetgreen down about 8%. Some concerns here about a drop in foot traffic amid all of the concerns about that cyclospora outbreak. Caterpillar giving back about 1.7%, while NVIDIA trying to get its mojo back. Investors re-embracing that stock on the day, up about 2%. Take a look at shares of Alphabet. Down about 1% on the day. In fact, down a third straight day to notch a weekly loss, and that's partly because of concerns out there about the amount of money that it's spending on the AI build-out. And that is our top story, because it's not just Alphabet. It's not just Alphabet bond buyers. A lot of people are getting antsy out there. So far this year, Alphabet, along with Amazon, NVIDIA, Meta, Oracle, SpaceX, they have together raised more than $200 billion from dollar bond sales. That dwarfs the $13 billion from high-grade tech companies in the same period last year. But the cost of capital, it's going up to issue those bonds. And once issued, we've seen those same bonds crater below the issue price the moment secondary trading began. To combat some of that cooling demand, underwriters are now trying to space out some of these debt sales. And Alphabet this week offered several concessions and pledged that this really would be its last U.S. bond sale this year. Maybe. There are a lot of other AI companies out there that need to tap the lending markets, including the folks involved in that Anthropic data center project out in Texas, which is backstopped by none other than Alphabet. One banker telling Bloomberg that some $50 billion to $60 billion in debt from hyperscalers will hit the market following the U.S. Labor Day holiday in early September, and that figure could be even higher. But some clients, they're actually requesting an issuance pause. That's what the banker told us, asking not to be identified, discussing private information. Well, let's talk on the record here with Momei Q, the head of venture over at PSP Growth. Talk a little bit more here about where we are right now with regards to this Capex spending, more importantly, the borrowing, Momei, that's funding it, and whether investors are cooling a bit to it, or is this just kind of a temporary, maybe a little bit like we need to figure out where things are going?
Hi, good afternoon. Happy Friday. Thanks for having me on. Yes, that is definitely the topic of the day, of the week. We saw in the earnings season this couple of weeks that Capex is really one of the main drivers of stock price movement. Not necessarily an earnings beat, but once you're a company that raises Capex guidance again, then the market starts being cautious. And the winners that we saw in some of the earnings report is really ones like Microsoft and Amazon, where you really are able to tie Capex to a direct benefit on the AI side, and that's Azure and AWS. And companies that couldn't do that, you see more caution from the market than optimism. And it used to be that any Capex spent in AI is a sign of AI ambition and rewarded, and we think that has changed. So on the borrowing side, you're right. We've seen a couple of companies this year already where the public markets are no longer enough to support their spend. Mm-hmm. They have to go to private markets. They have to go to the bond markets. And you saw that with Alphabet today. However, right, despite all the commentary here, the round is oversubscribed. There's more demand for this debt than they're able to issue. So that says that even though investors may be a bit cautious, the AI is still the space that everyone is excited about.
With regards to the economics of what's going on in the AI space, particularly when it comes to the LLMs, there's been a lot of discussion about a lot of corporate users trying to sort of scale back how much they're using, or at least scale back the cost of what they're using, basically controlling these AI costs. Does that become a factor at all, or is this just sort of the natural evolution of this build out?
Well, if you think of the natural evolution, right, when something matures, one of two things has to happen, and hopefully both. One is your cost has to go down, and the other is your adoption has to go up. And we're sort of in this phase now when we need to make improvements on both. So I think it's less simple than just we should cut down on spend, but what you're seeing is a increased focus on inference. In our portfolio companies, we invested in a couple of inference plays, including FAL and Together AI, where that allows corporates to manage their code tokens and their spend, not do less workload, but to do them more cheaply across different models. And then when you look at the adoption side, you're starting to see that curve mature, but it's still spotty and not very consistent. So the ones where we see incremental benefits, I think is not enough to calm some of the fears, is really some of the adoption use cases that are driving exponential results. So things where AI agents are actually working alongside your human workforce and not just accentuating one particular workflow. So a few companies we're excited about is one is Synthesia in AI communications, where you can actually have a sales manager train your sales force and take that workload off of them. You have Decagon, which is really improving customer service agents at a level the industry has never seen before. And then Factory, which is in AI coding, not only are they completing the code for you, but they're acting like an additional engineer to do the end-to-end. And those are the exponential things we need to see in the market to calm some of these fears.
I do want to get your thoughts, and this kind of refers to public companies, but I also, I'm sure this feeds into some of the companies that you look at as well. We did hear from some of the software companies. There's been a lot of talk about the traditional models. You had companies like Atlassian actually surprised pretty nicely to the upside. Palantir obviously at least appeared to sort of show that it actually had the chops as well. What is the business model, though, when it comes to software space and AI and the potential threat of AI usurping some of the more traditional software and services products? What is that model that you look for that is sort of ready for the AI age?
Yeah, I think for a while, certainly this year, you saw a lot of the seat-based companies really get crushed in the market because, at least theoretically, AI agents are supposed to replace headcount. And so if you have a seat-based business model, that's where you're the most vulnerable. But then to your point, Atlassian had a great run this week and off of great earnings. And so I think I would actually summarize it as people still don't know yet. You have all these AI capabilities being built out. And as I mentioned before, on the end user side, you're not quite sure exactly how the disruption is going to occur. And there's two sides of the story. There are the outright disruptors where maybe AI agents will take over all of the seat-based companies. But there's another story where if these traditional incumbent companies can incorporate AI into their solutions, then that's even better, and it can actually help them. And I think Palantir is a great example of that, where maybe that story is a little bit more tangible. If you're a company in a very verticalized, specific, mission critical vertical, then it's easier for people to think, okay, it's probably not likely that a corporation is going to vibe code their way into something so regulated and so important. And we have that in our private portfolio too. We have a company called Nominal that's really accelerating hardware development for planes, drones, machinery, cars. And then another company called Airspace Intelligence that's doing a 4D modeling and optimizing operations for aerospace. And so for companies like that in verticals, any sort of frontier model hallucination will be catastrophic. So you definitely need both the technology development, but also the guardrails and some of the more traditional workflows to support it.
I do want to get your broader thoughts here, Momei, on what's going on right now with regards to venture funding. There's been a lot of talk, particularly with when we had a pretty record quarter, or not record, but a pretty decent quarter for exits in Q2. There's been a lot of talk of how some of that money might actually circle back into the venture space. I mean, what is the state of that? And I'm also curious, just from your perspective as well. I mean, given you work for PSP, that's not based in the Bay Area. It's out there in Chicago. I mean, where is the state of venture right now? And is the epicenter still in the Bay Area, or has it kind of broadened out?
Yeah, it's a really good question. And to your point, we sit at an interesting spot where I spend the majority of my time still looking for the most cutting edge AI technologies. And I would say they're across the country, but the epicenter for now, a lot of it is still on the coasts. But the DNA of our company, PSP, is actually in more traditional older line industries. We're backed by Penny Pritzker, former Secretary of Commerce, and her family. The Pritzker family started Hyatt Hotels, started Marmon Group. The Midwest, to your point, is home to many Fortune 500 companies. So we really see both worlds. And the idea is we look for the most cutting edge AI technologies and solutions, but we connect them to real world use cases where there's actually benefit. And I think that's where the general venture market is shifting to, is when you're looking for these application layer companies, you're not just building the capabilities anymore on the infrastructure side. This is people that really have to pay money for it. They have to show ROI for it. And companies that's able to demonstrate that at scale, and that's where we have an interesting perspective into, is going to be the ones that will see revenue accelerate and see funding follow.
All right, Momei, great to have you on here. Momei Q, head of venture over at PSP Growth. A closer look at the state of tech, the state of venture as well. When we come back, we're going to take a closer look at the state of the restaurant industry, particularly given some of the concerns right now about 2 foodborne illness outbreaks going on. We heard from Sweetgreen this week. We're going to hear from Cava and Brinker next. We're going to set you up for that when we come back after the break, right here on Bloomberg. Shares of Sweetgreen lower on the week. So too were shares of Chipotle. So too were shares of Yum. So too were shares of Cava. A lot of concerns about cyclospora fears out there and just how much, if at all, it is hitting demand. We are going to hear from Cava and Brinker International, the parent company of Chili's, next week. Bloomberg's Daniela Sirtori joins us right now, who covers the major restaurant chains, to talk a little bit more about this. And Daniela, we kind of saw this with Sweetgreen already. They were very blunt about their most recent quarter, but also their forecast going forward, a contraction in same-store sales growth that they were putting squarely, or at least a big chunk of that squarely, on the outbreak of the cyclospora issue. Are you seeing this as maybe becoming a bigger issue for these restaurant companies?
It's been really interesting to watch because, of course, the first company to be hit by it was Taco Bell, the first one to be linked to the Cyclospora outbreak. And we did see, through third-party data, Bloomberg second measure, a steep decline in traffic at first. But it was quite interesting because, when its parent company, Yum, reported, they said that sort of impact was already abating. It actually has been really interesting to watch Sweetgreen being so hard hit, basically the brand already being picked while it's down because Sweetgreen wasn't even involved. Its product was not linked to the outbreak, but people are just very skeptical right now about anything that contains lettuce, even though Michigan actually, which is the state that has been hardest hit, has said that it's okay to eat lettuce again as cases go down.
Well, that's what I'm curious about. We should just be very clear. There's no link at all to Sweetgreen and most of the other companies we mentioned. But again, people see that lettuce or any sort of raw veggie could be sort of contaminated, and they sort of, put a broad brush. And then I was just reading the other day about a potential salmonella outbreak involving jalapenos. What do we know about that?
Yeah, so we first reported on Monday that Chipotle had been linked to a salmonella outbreak involving jalapenos. It started, the first sort of indications were in Minnesota, but there are other Mexican-style chains that were affected, Qdoba, and then, the next day the CDC and the FDA confirmed that this was indeed happening. What they did say, though, is that because restaurants such as Chipotle pulled the jalapenos pretty quickly, they don't have ongoing concerns about the safety of eating there. It's just about how much people are going to be vigilant about sort of the shifting messages, right? We know that there's an outbreak. The authority says it's fine. But as we have seen with the Cyclospora outbreak, once the information gets out there, it really spooks diners. And so Chipotle actually did come out and say that the guidance that they had given earlier last week when they reported earnings does not contemplate any impact from, these salmonella outbreak tied to jalapenos because there's just a lot of uncertainty. And also at the time when they gave it, no one knew about it. So we're going to have to see, too, as the information spreads, how consumers are going to react.
Yeah, absolutely. Here, and it kind of makes you wonder. Particularly, I know Brinker is a little bit more of a diversified menu, but then you think about Cava, obviously a lot of fresh greens and veggies on the menu there. Daniela, we'll catch up with you next week, I'm sure. Daniela Sirtori, who covers restaurants for us here at Bloomberg, and we do get earnings out of Cava next week. We'll be talking with the CEO as well, also from Brinker, too. All right, when we come back, we're going to reset here on the big program and talk a little bit more about the economy, particularly the labor market and particularly the New York economy. Julie Su, the first ever deputy mayor for economic justice. She joins us to talk about a new business advisory council, as well as some of the other initiatives that she says are going to make things a little bit more affordable for New Yorkers. That conversation coming up after the break, right here on Bloomberg. Now, Bloomberg reported earlier today that New York City Mayor Zohran Mamdani is asking top business leaders to join a new business advisory council. Now, the group is expected to provide feedback across key industries, including real estate, finance, and technology. Industries, we should say, that to some degree or another have been at odds with a lot of the mayor's proposals. New York City Deputy Mayor for Economic Justice, Julie Su. I had a chance to catch up with her about some of these potential appointments, as well as the city's newly implemented pied-à-terre tax, as well as those government grocery stores, job growth here in the city, and the potential for an increase in the minimum wage to $30 an hour. Take a listen.
New York City is not immune from all of the reasons why the federal economy has taken such a dramatic downturn. At the same time, we don't have to just take it. It's really important what we do. It's important, New York City is a big economy that also helps to affect the rest of the nation's economy. And what we're seeing here is a different picture. We've had over 21,000 jobs created in the city over the last 6 months. New York City-based companies have raised over $21 billion in venture capital, which is a 102% increase from the same time period last year. We've had companies open their global headquarters here. The mayor and I were both proud to stand alongside American Express when they broke ground on their 2 World Trade Center headquarters. And the Manhattan real estate market is the strongest it's been since 2000.
But you say 21,000 jobs created. Last year, for the entire year, or at least private companies, you only had maybe about 33,000 jobs created. You go back to 2024, we were at 100,000. Yeah. So that's a slowdown. That's a step down to a certain extent. Why?
It is. Unfortunately, if you look at those exact time periods, periods, right? 2025 was when the new federal administration came into office, and that was a terrible year for jobs. Like you noted, I think about a third of the number of jobs created in New York City were created in 2025 over the prior year, 2024. And, you know, it takes some pretty bad decisions, you know, wars, chaotic tariffs, to have that kind of dramatic impact. What we are focused on here in New York City is turning that around, right? Is doing everything we can to make sure that we're building as robust and strong an economy for shared prosperity as we can.
And that is your job. But your predecessor had a different title. It was the Deputy Mayor for Economic Development. You are the Deputy Mayor for Economic Justice, same role, more or less, but clearly a reimagining of what that role is supposed to be. What does economic justice do for creating jobs and building the economy?
So it actually is a very much expanded role. And for this mayor, the vision is that we have for too long in the city had a booming economy by large aggregate numbers, but one that was also deeply unaffordable. We've had, you know, an expanding skyline while New Yorkers were living ever shrinking lives. And we are no longer going to pretend that that's good enough. So the Deputy Mayor for Economic Justice, the job is to make sure that there's a competitive and level playing field, that we continue to grow the economy and measure that growth by how everyday New Yorkers are feeling, whether they can stay in the city, whether they can afford the basics of life, right? Housing, food, childcare, transportation, and ensuring, you know, we do not take the choice that you have to choose economic growth or economic justice. We believe that's a false choice, and we're choosing both.
Did that economic growth not lead to economic justice as well? I mean, the EDC is responsible for a lot of the changes in our skyline, from Hudson Yards to the Brooklyn Terminal, et cetera. Were the gains, the benefits from that, did they not matriculate evenly across the board?
Yeah, I think New Yorkers have made that clear, right, in what they've said, you know, in the sweeping mandate that this mayor had when he came to office. And you can't have a truly booming city if working people are being driven out, if people can't afford the basic cost of life. We put out a report that New Yorkers had demanded. They voted for this before we ever came into office, but we put it out showing that 62% of New Yorkers cannot afford the true cost of living in the city. That's 5 million people. So something is missing from how we measure the strength of the economy. And again, we want to do both. You know, I've been asked a lot, well, economic justice, do you actually care about economic growth? Of course we do. Of course we do. It takes economic growth to have justice, but it also takes justice to have the full amount of growth that we believe the city is capable of, and we're going to work on reaching its full potential.
How closely are you working right now with the business leaders here? Because some of them would argue that you're not going to achieve that without them. If they don't stay here and remain major employers, you're not going to achieve what you're trying to achieve.
So to be clear, we want them to stay here. Right? We know that
but they're threatening to leave.
And yet, we've seen, right, again, Manhattan office space is at rentals at an all-time high since 2000. I think it's like a quarter-century high. We've stood alongside companies who've broken ground, and truly, there is a lot of noise around what people say, and then there's what actually happens, and there's actually what happens also behind closed doors, right? The mayor and I have been engaged with those business leaders. We are setting up a business advisory council to make sure that we have ongoing interaction and feedback and communication and shared ideas. And truly, in those closed door meetings, what I see is a very shared commitment to and love for New York City, and an acknowledgement that we need government to function at its highest level, right? The mayor talks a lot about public excellence. We believe in that. It's not that people don't want to pay taxes, it's that they want their taxes to go to something that they can actually feel. And we are deeply committed to that. Everything from fixing potholes to delivering the first 2,000 childcare seats for 2K.
Well, with regard to the relationship with the business community, when do you anticipate that business advisory council will be up and running? And have you actually named anyone to actually be on it?
Soon. It will be announced soon. I don't want to get ahead of the mayor. I want to let him go ahead and announce.
Well, Bloomberg is reporting that there have been a few names already floated around, like Jose Tavares and Robert Wolf and a few others. Have you spoken to them?
Those are all people that we have been in conversation with. I have myself, the mayor has sat down with them. They're really important to New York City. And again, what I found in all of my years in government at the highest levels of state and federal and now the largest city in the nation is that there's far more that we share in common than anything that would divide us. And with business, they know why having a strong economy in New York City is important. They also recognize that when you can keep New Yorkers in New York City, that's their employees, right? That's their talent pool.
Well, with some of the initiatives that Mamdani has taken so far, and with, to a certain extent, the support of the council, talk about the minimum wage. There's a big proposal out there to take the minimum wage from $17 up to 30, I think, by 2030 was the idea. I assume you support that. Do you actually think that's going to happen?
So here's what I'll say about that. We know that affordability is about both sides of the ledger. It's about bringing down the cost of things, and we've been laser focused on that. It's also about making sure that working people can keep more in their pockets. That's a function of better jobs with higher wages. It's also about their ability to join a union and negotiate for better wages, right? Union wages always higher than minimum wages. There's a reason for that. When workers have a voice on the job, it's good for everybody. And I think it's also a function of cracking down on the ways that New Yorkers have been nickeled and dimed for a long time. The junk fees, the subscription traps. So we're taking an all of it approach to how we address affordability. And certainly making sure that working people get more in their pockets is a really important part of that.
And there's no concern that if you do have that such a meaningful increase in the minimum wage, that won't scare away some certain employers that just don't want to pay it?
I mean, I know that there's been for, time immemorial, the argument that even having a minimum wage was going to end, business as we know it. The sky was going to fall, and that's certainly not happened. What it's provided is a basic safety net, right? There should be a floor beneath which no one should be forced to live and work, and the minimum wage is one part of what represents that.
This is obviously a core function of what Mamdani had promised on the campaign trail. These new grocery stores, these subsidized grocery stores that are being opened, I think there's only five right now, but is the plan to expand this more? And with regards to the structure of the discounts, 30% below what you would pay in, I guess, on average in a different grocery store, can that be maintained? And is there going to be a mechanism in place to make sure there's not, arbitrage where people can just go there, get a 30% discount on something and then flip it for a profit?
Yes, so yes to all of those things. The plan is to open one city grocery store in each borough by the end of the mayor's current term. We have chosen 2 sites already, one La Marqueta in East Harlem and the other at Hunts Point in the Bronx. And you said it exactly right. The goal here is to make sure that New Yorkers can have access to fresh, healthy, affordable food in their neighborhoods. And the 30% off of the market rate for produce, for seafood, for meat, and some of the basic staples that New York City residents buy is our commitment. In fact, we have a survey happening right now that people can find online or go to their local library to learn what it is that people want to see in their grocery store. And this is something about how we want to govern, right? Which is that we're not here to dictate exactly what people need, but we are here to listen to everybody across New York City about what they want, what they need, what's going to make life better. And that's the grocery stores are part of that too.
All right, Julie, I have to ask you about the pied-à-terre tax. It's all anyone talks about. You guys sent out a notice last month. 17,000 people got it. It was a little messy, and there were clearly some errors on that. But I assume that the administration plans to move forward with the pied-à-terre luxury tax. And if so, do you have enough, I guess, legwork done already to make sure that the people are getting these notices and that the people that are going to be on the hook for it indeed are supposed to be on the hook for it?
Yes, so of course, the whole idea behind public excellence is that we do things the way they're supposed to be done, and people can expect a certain level of excellence from their government. And the pied-à-terre tax is an example of really, I give a lot of credit to the mayor and the governor for working together to find a way to raise the revenue needed for some of these things that we're talking about. Again, housing and childcare and transportation, schools, right? Things that are really signature to, parts of a livable city. And so these notices went out because it's a new tax, is a notice of you would potentially have to pay this. And to the extent that it went out, if somebody, it's supposed to be your like a second home that you're not living in that is valued at over $5 million, right? This is a tax on a small segment, really, of people who don't actually live in New York City, don't actually live on that property. And to the extent that there are people for whom that they're not supposed to pay that tax because they don't qualify under those terms, there is a mechanism to communicate that, and the mayor's just extended the time to do that also.
Have you spoken with Ken Griffin at all?
I've spoken to a whole lot of business leaders, not Ken Griffin himself.
Jim Whalen?
But yes. I mean, these are all really important people. And yesterday I was at an event for a Better New York, ABNY, where a lot of people who work in these organizations are. It was actually a women's event. We're really proud of the women's leadership in this city too. And the idea is that I do believe that, no offense to the news, but beneath the news cycle and the noise is where real work happens. And I have seen throughout my time in government that real work is collaborative, it's in partnership. And when you present a new vision, an idea that we don't have to think so small about what is possible in the city. We don't have to think of the economy as something that only benefits a few and everyone else is clawing for a secure space in it. We can build a bigger economy where everybody gets a fair shake and everybody gets to feel safe and secure and feel joy and experience art and culture. That's part of economic justice too in the mayor and my vision. When we do that, many people can get on board.
Julie Su, the New York City Deputy Mayor for Economic Justice and, of course, former acting U.S. Labor Secretary. All right, we go back to the markets here, and it was a good week for the markets. On a weekly basis, the S&P did close out today at a record high, up about 3.5%. Obviously, big tech powering that. In fact, the S&P 500 Infotech Index having its best week since mid-April. Coherent, Palantir, Corsair, some of the biggest names there. Meanwhile, you saw the downdraft in energy stocks as a lot of people now sort of pulling back out of that trade. And gold having a great week. In fact, one of its best weeks since January of 2026. This is The Close on Bloomberg. Spelman College, one of the top-ranked HBCUs here in the U.S., has a new president, Dr. Ayanna Howard, only a week on the job, beginning her term at the helm. I had a chance to catch up with her, and, well, she's got a lot that she's got to deal with. Of course, a big rollback and a lot of federal financial aid packages, the impact on AI, and, of course, a lot of questions about boosting that institution's endowment with a greater fundraising push. Here's what she had to say.
So my background is quite spread out, but I will tell you my origin story was at a liberal arts education. So I chose an undergrad institution because I was a roboticist AI specialist. That's what I wanted to do. But I chose a liberal arts because I wanted to make sure that as a whole person, I had that experience. And with the things that are changing, I truly believe in this age of AI that the humanities, the creative arts, the liberal arts is what's going to make humanity and humans relevant in this new world that we call AI and robotics.
I want to ask you just about the current crop of students coming in, not only for this year and beyond, and their ability to actually afford Spelman. Roughly about $60,000, which, actually compared to other universities is a modest bargain. But obviously there have been some significant rollbacks in some of the federal aid with regards to loans, a cap on the amount of loans that people in need can actually take, a cap that is basically about $20,000, I think $65,000 total for the student. That's well below what it takes to enroll at Spelman. Have you looked in your short time there so far into ways to sort of mitigate and close that gap between the students in need and what can actually be obtained?
Yeah, so one of the things is we have something called the Spelman Forward campaign, which is really going out and fundraising to really cover that gap. And I will say when the Spelman Forward campaign launched back in the spring, I will tell you, I did not realize how important this really is in this day and age. And so we are being more aggressive around asking our donors, our alums, corporate sponsors to do more because they need these students when they graduate. And if they have the debt and they can't go to grad school because of the limitations, they will lose an entire generation of students, excellence, working for them. And so it's a win-win proposition, but we will be more aggressive in ensuring that we can fill the gaps with respect to some of the limitations on the loans.
One more question about what's been going on in Washington, and that involves the rollback of some of the federal funding for university research, an initiative to put more of that money in the hands of private companies. How exposed is Spelman to that rollback in R&D coming from the federal government?
Yeah, so one of the things that we've had to do is fill in the gaps of some of our faculty that have lost their funding in areas that are really, really important, whether it's Black women health, whether it's thinking about the social justice and inequities in our society. And so we have been filling that gap we will go to mostly private corporations to think about how do we do more in this space, because these are areas, like with anything, research sometimes takes 4 or 5, a decade sometimes, to actually have your outcome. And so we will fill that gap even if we aren't able to get the grants from the federal government in certain areas.
All right, we have to talk about AI. Obviously, a hot topic, and it is your wheelhouse. And we should point out, I mean, I was asking you earlier about, whether you have a standalone engineering department. I mean, there are you guys have touted this for years. I mean, Spelman is the biggest producer of black women who go on to STEM PhDs. I assume, I don't want to put words in your mouth, you want to continue that trend.
Oh, of course, and even more.
Yeah. Well, talk to me about just how the AI boom overall fits into that, and whether that actually widens the pipeline, and I'm talking specifically for black women, or maybe potentially creates maybe some hurdles, some roadblocks up ahead.
So I think it widens the pipeline. So we're going to assume we are doing it correctly. And so we're going to be navigating and figuring that out over this next year. But what happens is that when you're out in the field, AI is a non-negotiable. It's already left the train station. It is, in fact, bullet speed ahead. And so how do we quickly ensure that our students, whether they're in the STEM or even the humanities, or they're interested in law, know how to use these tools in their discipline when they're going to grad school? I want to make sure that when they are day one sitting in that class and the professor is talking about, well, we're doing legal briefs and you need to use your chat bot to go through them, that they're like, oh, I actually did that as an undergrad. I know exactly what you're talking about. And so I think it widens it, because our students, when they're trained with those AI tools in their discipline, they will be, one, much more capable, but also they will beat out all the competitors.
Do you think, though, the students are going to embrace this? And I bring that up because this past graduation commencement season, there was a lot of hay made of some of the reaction by the graduates to some of the speakers talking and extolling the benefits in the future of AI. There's a lot of anxiety about displacement of jobs and just the general role of what AI will be in our lives. So when you have some young girl coming in, 17, 18, 19 years old, into the school this week here, do you think she's going to have that same enthusiasm for this technology that you have?
Well, this is the thing, and this is why the humanities and having this critical thinking skills is important. AI isn't all positive. We know that. And I'm an AI specialist. I am an optimist, but I'm also a realist. And the fact is we have, if you think about the water requirements, the energy requirements, the data center kind of boom, the fact that as we're using AI, we're losing some of our ability to think critically, like that is a reality. So what I want is, I do want that healthy criticism. I want students to say, look, what are you doing about X? What are you doing about Y? And let's have a conversation so we can move together, because the world is moving forward. I want our students to have a voice and a seat at that table, asking those hard questions so that we do get it right.
And that is the new president of Spelman College, Dr. Ayanna Howard. We'll be back in a moment. We're going to set you up for what to watch over the next week in financial markets. That's coming up next here on Bloomberg. As we close out a busy week, we push ahead to what the markets will have their eyes on next week. That includes several earnings from names like Rocket Labs as well as AST Mobile. That is on Monday. On Tuesday, we get some more earnings, a couple of consequential ones. Kava is set to report, but another read on the tech space with CoreWeave, Supermicro, as well as, and we're going to hear from On Holding as well to get a little bit more of a sense of what's going on in the retail space. We're also going to get some primary elections to keep an eye on: Connecticut, Vermont, Wisconsin, and a key one in Minnesota. On Wednesday, this is going to be big. Coming off of today's jobs report, we're going to get that U.S. July CPI number and get a better balance here, or maybe where the Fed goes next. We're also going to get earnings out of Cisco as well as Cerebras and StubHub. There's a big Made by Google event that we'll keep an eye on as well to see if that moves the market. And then on Thursday, Applied Materials steps up to the plate with earnings of its own, as well as from Tapestry, and another read on inflation, this time from the wholesale side with PPI. Friday, we round things out with two key pieces of economic data: retail sales and those UMich sentiment numbers. And we're going to get an update here on those 13F filings. We're going to get a better look here at how a lot of those funds ended the most recent quarter. We'll be back next week right here on The Close for all your political coverage. Stick around. Balance of Power is coming up next, right here on Bloomberg.